Imagine a regional bank posting an 89% EPS jump while, the rest of the sector is still crying about margin compression and deposit flight.
I mean, it's almost unheard of right now.
Right. Today, we are diving straight into the Q2 2026 earnings of Peapack-Gladstone Financial Corporation, ticker PGC. And the headline figures here are they're aggressively counter-narrative.
They really are.
Diluted EPS came in at 85 cents. That is up 6% sequentially. But that massive 89% jump year over year is what actually moves the needle.
Yeah, that's the number that jumps off the page.
Exactly. And total revenue hit $86.1 million, which is up 4% quarter over quarter and 23% year over year.
Which, just to give you some context, marks their 9th consecutive quarter of top-line growth.
9 quarters, that's a serious trend. And management also reiterated their long-term internal guidance targets, pointing directly at a 1.25% plus ROA and a 14% plus ROA.
So they're confident.
Very. And, we don't even need to hunt for the immediate aftermarket stock reaction or like Wall Street's specific consensus fractions today.
No, because the sheer velocity of that year-over-year growth, it basically operates as its own beat narrative.
Right. It signals this undeniable internal momentum that if you're a retail investor, you just need to understand.
Absolutely, because seeing 9 consecutive quarters of top-line growth in this specific, highly restrictive macroeconomic environment, it indicates their balance sheet positioning is structurally disjointed from their peer group.
Yeah, I mean, most mid-cap banks spent the last 2 years just playing defense.
Exactly. They were restructuring underwater bond portfolios or paying exorbitant rates just to retain deposits. But PGC has clearly shifted to offense.
It really feels like they've been this heavy freight train slowly building momentum, and now they finally hit top speed.
That's a good way to look at it. The underlying mechanics of that 89% EPS jump suggest they have moved past the defensive phase entirely and are now, scaling into a very deliberate operating model.
Well, we have to unpack the math on that scaling because the divergence between the top and bottom line is frankly jarring.
Oh, it is.
You have revenue up 23%, which is great, but EPS is up 89%. How exactly are they squeezing that much profitability out of the top line?
Well, let's look at the margins first. NIM expanded to 3.32%.
Okay.
That's a 6 basis point uptick from last quarter. But the broader context is wild. NIM is actually up 112 basis points from the Q1 2024 low.
Wow, 112 basis points.
Yeah, and that drove NII to $63.9 million for the quarter.
But, I mean, a 112 basis point NIM expansion alone doesn't artificially inflate EPS by 89%, right? There has to be something else.
You're right, it doesn't. The NIM expansion is just the foundation. The true accelerant here is the rigid expense control layered on top of it.
Ah, okay.
The metric that defines this entire Q2 release is the 10-to-1 ratio. Yeah, revenue growth outpaced operating expense growth 10-to-1. Top-line revenue surged 23%, but OPEX only crept up by 7%.
That is massive operating leverage.
It is. I mean, in banking, keeping expense growth to single digits while revenue expands by nearly a quarter is incredibly difficult due to inherent wage inflation and, technology costs.
Right. Everything costs more right now.
Exactly. So combining a widening NIM with a 7% OPEX cap creates this explosive positive operating leverage. That specific dynamic is what drove a staggering 70% year-over-year growth in PPNR.
So a 70% PPNR growth is showing us the pure operational engine, stripping out any noise from loan loss reserves or weird tax quirks.
Spot on.
And we see that flowing into the efficiency ratio, which ticked down to 65% for its 7th consecutive quarter of improvement.
7th consecutive. It's really impressive.
It is, but I have to play devil's advocate here for a second.
Go for it.
A 65% efficiency ratio looks great on paper, but they've been aggressively expanding their footprint into the New York metro region.
True.
And commercial real estate in Manhattan and poaching elite private bankers from wirehouses, that requires massive upfront capital. How are they absorbing those premier market costs while keeping OPEX growth at only 7%?
Well, the timeline of their capital allocation really answers that. The heavy lifting in the NY metro region was mostly done in previous cycles.
Oh, I see.
Yeah, when a bank pushes into a highly competitive premier market, the upfront operating expenses absolutely drag down the efficiency ratio initially.
Right, because you were paying signing bonuses, securing long-term leases, building the compliance infrastructure long before the revenue actually materializes.
Exactly. Revenue always lags expense in wealth expansion. But what we are seeing in Q2 2026 is the maturation of that specific investment cycle.
Okay, so the expenses have essentially normalized into a fixed base.
Right. And now the asset yields from those newly established NY relationships are finally coming online.
It's like they finished building the factory, and now every new widget off the line is just pure profit.
Exactly. The operating leverage is snapping in their favor because they are finally generating marginal revenue on a stabilized cost base.
Okay, I follow the logic on the stabilized cost base, but you can't just cut your way to growth indefinitely. Efficiency ratios eventually hit a floor.
Oh, absolutely. They do.
If this engine is going to keep running at this velocity, you need fresh raw materials. In this sector, that means fresh deposits and fresh loan origination.
Right.
So where is the actual fresh capital coming from to sustain a 23% revenue growth rate without just triggering a massive spike in funding costs?
So the capital is heavily concentrated in their wealth management segment. This division is basically the anchor of the entire franchise right now.
Okay, how big are we talking?
AUM is currently sitting at $13.9 billion, which is up 13% year over year.
Wow, 13%. But how much of that is just the market going up?
That's the thing. It isn't just market appreciation. It was fueled by $205 million in fresh net inflows during Q2 alone.
205 million in one quarter.
Yeah. And wealth management is highly capital efficient. It generates non-interest income without requiring heavy balance sheet usage. To contextualize the profitability, in FY 2025, that wealth segment operated at a 31% EBITDA margin.
41%. That provides incredible durability, especially because that fee income isn't subjected to the same aggressive interest rate risk as, the traditional loan book.
Precisely.
But how does that wealth anchor practically feed the traditional banking side? I ask because I'm looking at their deposit mix here. And the NIB DDAs grew 31% year over year.
Yeah, that number stands out.
It feels like a typo. We are in an environment where every retail client and corporate CFO is meticulously sweeping excess cash into 5% money market funds or short-term treasuries.
Oh, completely.
So growing zero-cost deposits by 31% right now basically defies gravity. How on earth are they doing it?
Yeah, it's a great question. The NIB DDA growth is actually the most critical metric in this entire release because it reveals the mechanics of their cross-sell.
The cross-sell, okay.
Yeah, it stems directly from what they call the single point of contact strategy outlined by CEO Douglas Kennedy.
What does that actually mean in practice?
Well, PGC positions itself as a private bank alternative to the global megabanks. They don't operate the wealth management product and the commercial lending wing in separate silos. It's a totally integrated ecosystem.
Oh, I see. It's like Apple's walled garden, but for commercial wealth.
That's a perfect analogy, actually.
You lure the CEO in with a high-touch personal trust account, and before they know it, you're processing their company's payroll and holding all their zero-cost operational deposits.
That is the exact mechanism. When they onboard a wealthy business owner, they manage the personal estate through the wealth division, capturing that 41% EBITDA margin fee income we talked about. But simultaneously, they capture the middle market company's operating accounts. And a business can't sweep all its daily payroll, vendor payments, and operational liquidity into a treasury bill.
No, it has to sit in a demand deposit account to keep the lights on.
Exactly. So by marrying the personal wealth relationship with the commercial treasury management, PGC captures those highly coveted, sticky zero-cost deposits.
Okay, so they capture the business's operating accounts for the cheap funding, and they manage the owner's personal liquidity for the fee income. That naturally leads to the loan book, right? I assume this exact same ecosystem is what's driving their credit origination.
It is the primary driver. Gross loans are at $6.7 billion, but the composition is what you really need to watch here.
What's the breakdown?
C&I loans grew 15% year over year and now make up 44% of their total loan portfolio.
Meaning they aren't just passively loading up on generic commercial real estate paper?
Right. They are leaning heavily into operating companies. This integrated commercial-heavy strategy is gaining serious traction, and not just with clients, by the way.
Oh, who else?
The recent $30 million preferred stock placement from strategic value bank partners is a massive institutional validation.
Yeah, let's talk about SVB partners for a second, because a 30 million preferred placement isn't just retail FOMO.
No, definitely not.
SVB Partners is a highly specialized long-term institutional investor in the banking sector. They conduct exhaustive balance sheet forensics before committing any capital.
They do. They don't write an eight-figure check unless they fundamentally believe the underlying architecture, in this case, that wealth to C&I cross-sell, is both scalable and sustainable.
So institutional money at that scale operates as a seal of approval on the underwriting standards and the business model as a whole.
It really does. It suggests SVB Partners modeled out PGC's yield curve sensitivity and determined the wealth anchor provides enough reliable cash flow to support future expansion.
Okay, so the cross-sell is clearly working and institutional money is validating it. But let's pump the brakes on the champagne for a minute.
Fair enough.
PGC is pitching themselves as a private bank alternative, but they are still a regional bank at their core. Does having a massive wealth anchor actually insulate them from traditional credit risks in their loan book?
Insulate. No.
Because you can have the most elite wealth managers in New York, but if a commercial real estate portfolio blows up, it drags the entire equity valuation down with it.
That's the reality of banking. A robust wealth division provides a buffer against earnings volatility, sure, but it absolutely does not insulate the balance sheet from credit risk.
Right.
The downside analysis is crucial here, because while the headline profitability metrics are pristine, the credit quality metrics require some real scrutiny.
Let's dig into that.
Non-accrual loans ticked up quarter over quarter to 68 million, compared to 59.3 million in Q1.
Okay, I need to interrupt there because the longer-term context on those non-accruals is really important for you to know. Yes, 68 million is an uptick sequentially, but that is still down significantly from the 115 million in non-accruals they were carrying back in Q2 of 2025.
Right. That's a very fair point.
The macro trend year over year is heavily positive, but I agree, any sequential reversal warrants attention.
And the sequential reversal is the focal point, specifically when you look at the aging of the portfolio.
What the aging metrics showing?
Well, loans past due over 90 days and still accruing just appeared on the balance sheet at 3.3 million.
Just appeared.
Yeah, that metric was sitting at absolutely zero for the previous 4 consecutive quarters.
Huh. I mean, a 3.3 million past due on a 6.7 billion total loan book is statistically minuscule. We are talking about fractions of a percent.
Yep.
But it feels like the first crack in the windshield, you know? Going from absolutely zero to 3.3 million means a specific borrower or a specific class of borrowers suddenly hit a wall.
That's exactly how you have to look at it.
So when you look at the composition of that loan book, where is the structural vulnerability that could cause that crack to spiderweb?
The vulnerability that stands out immediately is their exposure to New York rent-regulated multifamily, or NYRRMF.
Oh, okay.
That specific segment makes up 13% of their total loan book.
13% is a heavy concentration for a sector that has been, frankly, notoriously toxic for regional banks lately.
Very toxic.
The legislation surrounding New York rent-regulated spaces fundamentally broke the traditional lending model there. We're talking about the 2019 laws that severely capped how much landlords can raise rents to cover major capital improvements or just regular renovations.
Yeah, but the legislative constraints are only half the problem. The other half is the interest rate reality.
Right, the macro environment.
Because the traditional math for a multifamily building relies on net operating income growing to cover the eventual debt service upon refinancing.
But because of those 2019 rent laws, the income on these properties is essentially frozen.
Exactly. And meanwhile, the interest rates on these 5-year and 7-year commercial mortgages have completely doubled.
Ouch.
So when these loans reset, the landlords simply can't raise rents to cover the new, much higher debt service.
So the equity in the property just gets wiped out and the bank is left holding the bag on an underwater asset.
That's the fear.
So if you are a retail investor looking at that 13% NY multifamily exposure combined with this sudden 3.3 million 90-day past due blip, are we looking at a localized anomaly here, or is this a canary in the coal mine for that entire 13% block?
Well, management is hyper-aware of the friction in the specific portfolio. In the earnings release, CEO Kennedy explicitly referenced the balance sheet repositioning they undertook back in Q1 2024, and he called it highly disruptive.
Highly disruptive. That phrasing is very intentional.
Oh, absolutely. In banking, a highly disruptive repositioning usually means taking the pain early.
Right.
It means actively working out problem loans, recognizing losses on underwater securities, and tightening underwriting standards at the expense of short-term earnings.
They essentially amputated the worst offenders in 2024 to save the rest of the portfolio, which, explains why the total non-accruals are down so drastically from those 2025 peaks. They took their medicine early.
They did, and taking that medicine cleared the runway for the current streak of positive operating leverage. I mean, the 10-to-1 expense ratio and the 70% PPNR growth, those are the direct mathematical results of enduring that 2024 disruption and shifting capital toward highly efficient businesses like wealth management.
But that 13% NYR RMF exposure means they're still heavily tethered to the reality of the New York real estate market.
They are. If cap rates expand further, or if a larger cohort of landlords face a liquidity crunch upon refinancing this year, that 90-day past due number will scale up rapidly.
It's a real high-wire balancing act. On one hand, you have this incredibly profitable, rapidly growing C&I loan book being funded by zero-cost deposits gathered by an elite wealth management team.
Right.
On the other hand, management is constantly playing defense, just managing the runoff and the legislative risks embedded in their older real estate portfolios.
Exactly. And the current Q2 numbers prove that, at least for now, the engine of the wealth and C&I cross-sell is vastly overpowering the drag of the legacy real estate exposure.
For now, yeah.
But as an analyst, you keep that 13% NYRRMF figure circled in red ink on your monitoring list. It is the designated pressure point for this stock moving forward.
Which brings us to the ultimate friction point for anyone holding or evaluating PGC right now. We've seen this operational model hit top speed.
Yep.
They have achieved an 89% EPS jump, a 112 basis point NAI expansion, and just incredible positive operating leverage in a volatile, restrictive interest rate environment that has absolutely crushed their regional peers.
It really has.
So what happens to their highly profitable C&I and wealth segments if macroeconomic conditions and funding costs actually loosen up? Does this engine run even hotter with macro tailwinds?
It's a great question to end on. The upside scenario is compelling, definitely.
Yeah.
But the real risk lies in the scalability of that single point of contact model.
How do you mean?
Right now, they are successfully poaching middle-market CEOs and regional business owners. But as they grow their $13.9 billion AUM and push further into the ultra-high net worth space, they will inevitably bump up against the global megabanks.
Right.
Can a mid-cap regional bank consistently outcompete JP Morgan or Morgan Stanley for a $50 million family office account? That is the ceiling they will eventually have to test.
That is a fascinating dynamic to watch play out. Well, if you want to stay ahead of the markets and catch this level of deep dive analysis on the reports moving the tape, make sure to follow the show for daily earnings coverage.